Welcome back to our lesson in auditing. For today, we will be talking about the auditor's report. So there are several types of audit report. So the main types are the unmodified, or they also call it as unqualified report, and we also have the modified reports. But if we will go to the specifics, there are a total of 4 types of audit report. So the first one, we have the unmodified or the unqualified audit opinion. We have also the qualified opinion, and the qualified opinion may be due to the departure from the applicable financial reporting framework, or the qualified opinion is due to a scope limitation. The third one is we have the adverse opinion, and the last one is the disclaimer of opinion. In the unmodified or unqualified opinion, this is expressed by the auditor when the auditor concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. So in this type of opinion, the auditor can conclude that the financial statements are clean in terms of material misstatements. When we say a qualified opinion, again, it may be due to the departure from the PFRS or the PAS, or because of the scope limitation, which can be either management imposed or it could be circumstances imposed. For the first reason for the qualified opinion, uh, the qualified opinion may be expressed by the auditor when the auditor concludes that the unqualified opinion cannot be expressed, but the effect of any misstatement individually or in aggregate are material but not pervasive. So if for the auditor, in the entirety or in general, the financial statements are fair, but except for some parts wherein it remains to be material. But you have to take note that they are only material but not pervasive. So if there are some parts of the financial statements wherein there has been no modifications or amendments and they remain as material misstatements, so that's why there would be an except for paragraph. So except for this part, because this part is still contains material misstatements. And then if the reason is due to scope limitation, and the effect is material but not pervasive, so again, we're going to provide a qualified opinion. So what do we mean by scope limitation? So the auditor was unable to gather enough evidence, gather sufficient and appropriate audit evidences, because it may be again due to the limitations that are imposed by the management. The management is not that cooperative with the auditor, or it could be for reasons such as the circumstances, the situation prevents the auditor from being able to gather enough evidence. But if the departure from the applicable financial reporting framework or the scope limitation is not only material but also pervasive, if it is both material or and pervasive, not or, material and pervasive, so the auditor will express adverse opinion if it is due to the incomplete nature of the FS due to the effect of the misstatements or due to the departure from the applicable financial reporting framework. You will be, or the auditor will be providing the adverse opinion. But if it is due to a scope limitation that is material and pervasive, so there is a difficulty of the auditor to provide an opinion because of the potential interaction of the uncertainties and their possible cumulative effect on the FS, which will result to the inability of the auditor to obtain sufficient appropriate evidence. And again, the effect is both material and pervasive. So therefore, the opinion that will be provided is a disclaimer of opinion. So there would be additional paragraphs to the auditor's report. So there could be an additional paragraph such as the emphasis of matter paragraph, or there could also be other matter paragraphs. So what would be the difference between the two paragraphs? So if it is an emphasis of matter paragraph, this paragraph would state there or would explain to a certain matter which is appropriately presented or disclosed in the FS. And in the auditor's judgment, it is very important that the readers would know this specific matter. That's why in order to emphasize it, there should be an emphasis of matter paragraph. So you have to take note that the matter that is being discussed in this paragraph should be present or it should be found in the FS. Because if the matter that is being expounded on this paragraph is not in the financial statements, they are not present or they are not disclosed, then the name of the paragraph that will be added would be the other matter paragraph. Okay, so the same purpose why the emphasis of matter paragraph is made, that is to um, bring to attention or to magnify the matter or the topic. So if the matter is found in the FS or disclosed in the FS, the name of the paragraph is emphasis of matter paragraph. But if the matter is not included in the FS or not disclosed in the FS, so it's called as the other matter paragraph. So let us talk more about these paragraphs. So the first one, we have the emphasis of matter paragraph. So this is needed in order for the uh, auditor to draw the user's attention to a matter that is presented or disclosed in the FS. So the auditor shall include an emphasis of matter paragraph in the auditor's report, provided that the auditor would not be required to modify the opinion in accordance with PSA 705 as a result of the matter. So this means that there has been no modifications in the opinion. So in short, the opinion is still unqualified or it is still unmodified. The only thing that makes it different with the standard report is that there's an additional paragraph. But it does not mean that if there's an additional paragraph, such as the emphasis of matter paragraph, it does not mean that the opinion was changed. It is still unqualified opinion. When PSA 701 applies, the matter has not been determined to be a key audit matter to be communicated in the auditor's report. So, meaning the item or the topic that is brought out in the emphasis of matter paragraph is not part of the key audit matters, because we have a separate section for the key audit matters. So, if you have this emphasis of matter paragraph, this is not part of the key audit matters that will be discussed also in the separate section of the key audit matters paragraph. So when the auditor includes an emphasis of matter paragraph in the auditor's report, there should be a appropriate heading or title which is called as the emphasis of matter. So it should be clearly identified. Second, include in the paragraph a clear reference to the matter being emphasized and to where relevant disclosures that fully describe the matter can be found in the financial statement. So you have to point out where you can find the more information about the matter. So the paragraph shall refer only to information presented or disclosed in the FS and indicate that the auditor's opinion is not modified. So again, the opinion is still unqualified even if there is an additional paragraph, such as the emphasis of matter paragraph. So, in what circumstances would an emphasis of matter paragraph may be needed? So, the first one is when a financial reporting framework prescribed by law or regulation would be unacceptable, but for the fact that it is prescribed by law or regulation. Second one is to alert users that the financial statements are prepared in accordance with a special purpose framework. And what are these special purpose frameworks? So these are the frameworks or the standards that applies to financial statements that are intended for a specific purpose or for a different purpose and not for general purpose. And third, when facts became known to the auditor after the date of the auditor's report and the auditor provides a new or amended auditor's report. So, what are the examples of these circumstances which wherein there may be a necessity for an emphasis of matter paragraph? So, the first one is it could be uncertainty relating to the future outcome of exceptional litigation or regulatory action. So, there may be some uncertainties or unsure whether what would be the result of a pending litigation. It could also be due to significant subsequent events. So we already know what subsequent events are. So these are the events that happen after the date of the financial statements or after the FS date, um, but until the release or the approval of the financial statements. So that's the period between the FS date and the approval of the financial statements, ready now for release. It could also be an early application of a new accounting standard that has a material effect on the financial statements, and it could also be due to a major catastrophe that has had or continues to have a significant effect on the entity's financial position. So now let's go to the other matter paragraph. So what would be the instances or cases wherein other matter paragraph may be added to the audit report? So we have the first one is if we want to communicate a matter other than those that are presented or disclosed in the financial statement. So we have to remember that the other matter paragraph is intended to draw the user's attention to matters which were not presented in the financial statements. So they are not line items, they are not part of the schedules, or they are not expounded, or they are not described or explained in the notes to financial statements. That's why it's called as the other matter. These are other matters aside from those that are found in the financial statements, provided that what we will be discussing or identifying in the other matter paragraph are not prohibited by law or regulation to be discussed in that paragraph. We have the second one is if we want to communicate the planning and scoping matters in the auditor's report as required by law or regulation, or we want to explain why it is not possible for the auditor to withdraw from the engagement even though there is a pervasive effect of the scope limitation which is due to management imposed limitation. Or it could be to state that the auditor's report is intended solely for intended users and should not be distributed to or used by other parties, as in the case of a financial statement which is prepared for a specific purpose. So again, we have to remember that the content of this other matter paragraph should reflect clearly that the matter being discussed or identified is not required to be presented and disclosed in the financial statements. So it does not include any information the auditor is prohibited from providing. For example, the ethical standards related to confidentiality of information, because we all know that if we are covered with these ethical standards, we're not allowed to disclose any information unless we are allowed to. And second, information that is required to be provided by management. So it does not include those that should be disclosed by the management. So what would be the relationship between the emphasis of matter paragraph and the key audit matters? So we already know that there is a paragraph separately for emphasis of matter, and there's also another paragraph for the key audit matters. So communicating key audit matters provides additional information to intended users of the financial statements to assist them in the understanding the matters that, in the auditor's professional judgment, were of most significance in the audit and may also assist them in understanding the entity and areas of significant management judgment in the audited FS. When PSA 701 applies, the use of the emphasis of matter paragraphs is not a substitute for a description of individual key audit matters. So it means here that if we do not intend to insert a key audit matter paragraph, it doesn't mean that the emphasis of matter paragraph will suffice. So if the matters uh, qualify as a key audit matter, then it should be provided in the key audit matters paragraph. There may be a matter that is not permitted to be a key audit matter, but in accordance with PSA 701, it did not require significant auditor attention, so it is fundamental to users' understanding. For example, it is a subsequent event. To draw users' attention to such a matter, so the matter should be included in the emphasis of matter paragraph. So we should be able to identify which items will fall under the emphasis of matter paragraph and which should be part of the key audit matters. So remember, we have those examples of the circumstances in the previous slides that showed us what would be the examples and what would be the circumstances that would typically require an emphasis of matter paragraph. So where do we place the emphasis of matter paragraph? So when the emphasis of matter paragraph would relate to the applicable financial reporting framework, including circumstances where the auditor determines the financial reporting framework prescribed by law or regulation would otherwise be unacceptable. So the emphasis of matter paragraph would be presented immediately following the basis of opinion section. When at the same time, there is a key audit matters section or paragraph in the auditor's report, so where do we place the emphasis of matter paragraph? So we will place it either directly before or it could be after the key audit matters section based on the auditor's judgment as to the relative significance of the info included in the emphasis of matter paragraph. And the auditor should also add further context to the heading. So it's not simply emphasis of matter, but we could indicate it as depending on the topic that is being identified. So for example, we can add word in the heading as emphasis of matter subsequent event. So how about if there is also other matter paragraph? So when there is a key audit matter section that is presented in the auditor's report and other matter paragraph would also be necessary. So how do we present the other matter paragraph? So the auditor may add further context, just like in the emphasis of matter paragraph, to differentiate the other matter paragraph from the individual matters that are described in the key audit matters section. When an other matter paragraph is included to draw users' attention to a matter relating to other reporting responsibilities, so the paragraph may be included in the report on other legal and regulatory requirements section. So when relevant to all the auditor's responsibility or users' understanding of the auditor's report, so a separate section following the report on the audit of financial statements and the report on other legal regulatory requirements. Now let's go to the going concern considerations. So we already know that the management is responsible for determining or assessing if the company will be able to continue as a going concern. But what if the auditor has a different judgment on the ability of the entity to continue in a going concern? perspective. So here are some of the situations and the auditor's procedures and report that would be appropriate. So the first one is if the going concern assumption is appropriate but material uncertainty exists. So the auditor shall determine whether the financial statements adequately disclose the principal events or conditions that may cast significant doubt on the entity's ability to continue as a going concern and what are management's plans to deal with these events. And if the financial statements also disclose clearly that there is material uncertainty. So if the auditor was able to gather evidence that there is adequate disclosures as required, then the auditor shall express unmodified opinion with emphasis of matter paragraph. But if the auditor concludes that the disclosures are not enough, they are inadequate, then the auditor shall express a qualified or adverse opinion as appropriate and should include specific reference to the fact that there is material uncertainty. Second one is the going concern assumption is appropriate, but this time there are multiple uncertainties. So the auditor may consider it appropriate to express a disclaimer of opinion instead of adding emphasis of matter paragraph. If the use of the going concern assumption is appropriate but no material uncertainty exists, so the auditor shall evaluate whether there are adequate disclosures about these events or conditions. So in the first three scenarios, the going concern assumption is appropriate. Now this time, what if the going concern assumption is inappropriate? So the auditor shall carry out additional procedures and shall exercise professional judgment in determining whether the entity will be able to continue as a going concern. So if the auditor concludes or based on his judgment, the going concern assumption is not really appropriate, but the financial statements are presented in a going concern, so the auditor shall express an adverse opinion whether or not there are enough or adequate disclosures. And the auditor determines going concern assumption is still not appropriate. Next one is the going concern assumption is inappropriate, but the management was able to present or prepare the financial statement using alternative authoritative basis. So since they think that going concern assumption does not suit the present condition or the future condition of their company, so they use a different authoritative basis. So the auditor shall carry out additional procedures and shall exercise professional judgment in determining if that alternative basis is appropriate. So if the auditor uh, was able to gather evidence that it is appropriate and there is adequate disclosure, so the auditor can issue unqualified opinion but with emphasis of matter paragraph. Last but not the least, so what if management is unwilling to make or extend its assessment? So the auditor shall consider if there are any implications for the auditor's report. Now let's go to the different modified opinions. So we already know that there are three modified opinions. So we have the qualified, the adverse, and the disclaimer of opinion. So the type of the modified opinion largely depends on the nature of the misstatements or the nature of the inability to gather evidence and also on the materiality and pervasiveness of the misstatements or the effect of the inability to gather evidence. So if the financial statements are deemed to be materially misstated because of any departure from the standards or the applicable financial reporting framework, so the audit report can either be qualified or adverse, again, depending on the pervasiveness of the effects or the possible effects on the financial statements. So it is given that if you modify the report, there would be material misstatements or there would be material effects on the financial statements because of the inability to gather enough evidence. But the type of modified opinion will again depend if the effect would be material or and pervasive, or material alone or material and pervasive. So if it is material but not pervasive, so meaning material only, so the type of modified opinion would be a qualified opinion. Again, if there is misstatements in the financial statements. If the effect is material and pervasive, so it would be adverse opinion. If there is inability to gather evidence because of a scope limitation, so we already know that the scope limitation could be management imposed or it could be circumstances imposed. So if the effect is material but not pervasive, it's qualified opinion. And if it is both material and pervasive, then that is a disclaimer of opinion. So if you're going to compare and contrast the situations, so if it is material but not pervasive, so both are qualified opinion. So these are except for opinion. But if both material and pervasive, so it could either be adverse opinion or a disclaimer of opinion, depending on the nature of the matter that give rise to the modification. So as mentioned in the previous slide, so there may be some causes why the auditor's report may be modified. So we have mentioned about the material misstatements and we have the scope limitation. So let us define what is misstatement according to PSA 450. So a misstatement is a difference between the amount, classification, presentation, or disclosure that is required for the item to be in accordance with applicable financial reporting framework. So if it does not follow what is stated in the standards, so it's considered as a misstatement. But what are the other uh, scenarios or causes why there could be a misstatement in the financial statements? So the material misstatements could be due to the inappropriateness of the selected accounting policies, or it could be the misapplication of the selected accounting policy, or the inappropriateness or inadequacy of the disclosures in the financial statements. So let's go to number one. So the appropriateness of the selected accounting policy. So it is considered as a misstatement if it is inappropriate or it is not consistent with applicable financial reporting frameworks. So the financial statements, including the related notes, do not represent the underlying transactions and events in a manner that achieves fair presentation. Or number two, the application of the selected accounting policies is not correct or it's not consistent with the financial reporting framework, or it could be inconsistent also with regards to its application between periods or with similar transactions. So the method of application of the selected accounting policy, such as the unintentional error in the application. So that might be one cause of the material misstatements. And we have the third one. We have the inadequate disclosures or inappropriate disclosure. So it means the financial statements do not include all of the disclosures required by the applicable financial reporting framework, or disclosures in the FS are not presented in accordance with applicable financial reporting framework, or the financial statements do not provide the disclosures necessary to achieve fair presentation. So if these three exists in one form of the or another, so these are considered as misstatements. So now we proceed to the scope limitation. So scope limitation is the inability of the auditor to gather sufficient and appropriate evidence, which may be due to, first, the management imposed scope limitation, or second, circumstances imposed scope limitation. So the management imposed scope limitation happens wherein the auditors cannot gather sufficient appropriate evidence because of the client's deliberate refusal to provide access to documents or otherwise limit the auditor's application of the auditing procedure. So in short, the management here or the client is not cooperating with the auditor. So what should the auditor do? The auditor shall request the management to remove the limitation, and if the management refuses, so the auditor shall communicate the matter to those charged with governance and determine whether it is possible to perform alternative procedures to obtain sufficient appropriate audit evidence. If it is a circumstances imposed scope limitation, which means this is beyond the control of the auditor, so this would arise when the entity's accounting records may be inadequate or when the auditor is unable to carry out the audit procedure believed to be desirable. So the auditor here would attempt to carry out reasonable alternative procedures to obtain sufficient appropriate audit evidence to support an unqualified opinion. But what if still the auditor was unable to gather enough evidence because of the scope limitations faced, either those imposed by the management or those that are consequent to the circumstances? So the auditor's report should describe the scope limitation and indicate the possible adjustments to the financial statements that might have been determined to be necessary had the limitation not existed, and if the auditor satisfies himself through the application of the alternative procedures and there is no significant limitation on the scope of the auditor's work and qualification of the report is not necessary. But again, if unable to gather enough evidence despite all the efforts of the auditor, so the audit report might be qualified or it could be disclaimer depending on the materiality and pervasiveness of the potential effects of the scope limitation. Now that we already know what are the typical causes for the modification of the audit opinion, now let's go to how the opinion section is written depending on the type of modified opinion. So the first one here is the qualified opinion, which is due to material misstatements in the financial statements. So the opinion section will appear like this. So of course we have our heading, which is the type of opinion. So we have the qualified opinion, and then it will state this way. In our opinion, except for the effects of the matters described in the basis for qualified opinion paragraph, the financial statements present fairly in all material respects in accordance with applicable financial reporting framework. But if we can identify what would be the reporting framework that is used as our criteria, so we can express here explicitly the specific framework. So for example, we're going to use the Philippine Financial Reporting Standards. So this will be the statement if we're using a fair presentation framework. If we are using a compliance framework, so this would be the statement in the qualified opinion. So it will go, in our opinion, except for the effects of the matters described in the basis for qualified opinion paragraph, the financial statements have been prepared in all material respects in accordance with the applicable financial reporting framework. So what do we mean by this except for? So it just means that overall the financial statements are okay. They are fairly presented, but there is an exception. There is this part which we believe would still be material and could provide a material effect in the financial statement as a whole. And since this was not amended or this was not corrected, so that's why the opinion would be qualified. Because if there are parts or there are material misstatements that were corrected and amended by the management, so the auditor will not express modified opinion, but it will provide unqualified opinion. But since not everything was amended and there are still areas or accounts or transactions that are material and could also have material effect on the financial statements as a whole, so therefore the opinion would be qualified. Okay, that's why there's an except for statement. If the qualified opinion is due to scope limitations, so this is how it will be presented. In our opinion, except for the possible effects of the matters described in the basis for qualified opinion paragraph, the financial statements present fairly in all material respects in accordance with applicable financial reporting framework. So again, we will specify the specific framework. So for example, if we're using PFRS, then we're going to indicate that in this paragraph. So again, there is the phrase except for, because except for this part only. And then if you're going to compare that with the previous slide, this one have the possible effects, okay? Possible effects of the matter or matters that were identified in the basis for qualified opinion paragraph. Now let's proceed to the adverse opinion. So under the adverse opinion section or the opinion section, so it will state there, in our opinion, because of the significance of the matters described in the basis for adverse opinion paragraph, the financial statements do not present fairly in accordance with applicable financial reporting framework. So this is straight to the point that the financial statements are not presented fairly. Okay, so it already concluded that in general, overall, the financial statements are not fairly presented. Okay, so this type of opinion is given if the effects of the misstatements are both material and pervasive. And then the other way of saying this could also be the financial statements have not been prepared in all material respects in accordance with applicable financial reporting framework. So if this is using a compliance framework. Now let's proceed to the disclaimer of opinion. So when we disclaim, it's like I cannot say anything about it. Why can't you not say anything about it, or why can't you provide your opinion? Because I don't have any uh, sufficient appropriate evidence to be used as basis for my opinion. So I don't think it is proper for you to judge if there's no enough evidence. So just like in the court, if there's no enough evidence to convict a suspect, so you cannot convict the suspect right away. So there should be sufficient and appropriate audit evidence. So how will the audit opinion be presented? So because of the significance of the matter described in the basis for disclaimer of opinion paragraph, the auditor has not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion, and accordingly, the auditor does not express an opinion on the financial statements. So here, the auditor states that I cannot say that it is fairly stated. I cannot also say that it is not fairly stated because I don't have the basis. So if you don't have the evidence, so you cannot provide a conclusion or a judgment to that matter. Now let's proceed to the comparative information. So what are So what are comparative information? So there are two comparative information. It could be the corresponding figures, or it could be the comparative financial statements. So comparative information are the amounts and disclosures included in the financial statements in respect of one or more prior periods in accordance with applicable financial reporting framework. So first here is the corresponding figures. So these are comparative information where amounts and other disclosures for the prior period are included as an integral part of the current period financial statements. And these are intended to be read only in relation to the amounts and other disclosures relating to the current period, which is referred to as the current period figures. So these are not presented as a complete financial statements capable of standing alone. So these are just parts. And the level of detail presented in the corresponding amounts and disclosures is dictated primarily by its relevance to the current period figures. When corresponding figures are presented, the auditor's opinion shall not refer to the corresponding figures except when required by PSA 705. Okay. On the other hand, we have the comparative financial statements. So since it's a financial statement, so it's not just parts. It's a entire or not entire. It could be one type of financial statements that is presented in comparison with another financial statements of another period. So these are comparative information where amounts and other disclosures for the prior period are included for comparison with the financial statements of the current period. So you have to take note that the amounts and also the disclosures of the prior period are placed in comparison with the FS of the current period, but if audited, are referred to in the auditor's opinion. So these are also referring for the prior periods which are considered as separate financial statements. So they're capable of standing alone. The level of information included in those comparative financial statements is comparable with that of the financial statements of the current period. So you can place it side by side. So you have the column for the current year, and then you also have the column for the prior year. So that's so you compare the financial statements. When comparative financial statements are presented, the auditor's opinion shall refer to each period for which the financial statements are presented and on which an audit opinion is expressed. So what are the audit procedures related to the corresponding figures and the comparative financial statements? So first, let's talk about the corresponding figures. If the auditor's opinion on the prior period as previously issued included a modified opinion, and the matter which gave rise to the modification is still unresolved, the auditor shall modify the auditor's opinion in the current period's financial statements. So in the basis for modification paragraph, the auditor shall either refer to both the current period's figures and the corresponding figures in the description of the matter giving rise to the modification when the effect of the matter on the current period's figures are material. In other cases, explain that the audit opinion has been modified because of the effects of the unresolved matter on the comparability of the current period's figures and the corresponding figures. If the auditor obtains audit evidence that a material misstatement exists in the prior period FS on which an unmodified opinion has been previously issued and the corresponding figures have not been properly restated or appropriate disclosures have not been made, the auditor shall express a qualified opinion or an adverse opinion in the auditor's report on the current period FS modified with respect to the corresponding figures included therein. Meanwhile, in the comparative financial statements, so these are the audit procedures that will be carried out. So when reporting on prior period FS in connection with the current period's audit, if the auditor's opinion on such prior period FS differs from the opinion the auditor previously expressed, the auditor shall disclose the substantive reasons for the different opinion in the other matter paragraph in accordance with PSA 706. If the prior period FS audited by a predecessor auditor, so in addition to expressing an opinion on the current period's FS, auditor shall state in another matter paragraph that the FS of the prior period were audited by a predecessor auditor, the type of opinion expressed by the predecessor auditor, and if the opinion is modified, the reasons therefore, and the date of that report, unless the predecessor auditor's report on the prior FS is reissued with the FS. Now, if the auditor concludes that a material misstatement exists that affects the prior period FS on which the predecessor auditor had previously reported without modification, the auditor shall communicate the misstatement with the appropriate level of management and those charged with governance and request that the predecessor auditor be informed. But what if the prior period FS is not audited? So this auditor shall state in the other matter paragraph that the comparative FS are unaudited. Such a statement does not, however, relieve the auditor of the requirement to obtain sufficient appropriate audit evidence that the opening balances do not contain misstatements that materially affect the current period's FS. So that's the end of the part 1 of the auditor's report. So see you in our next lesson on the part 2 of the auditor's report lesson.